Okay, so now for a pretty big question, which is 14 marks, we're asked to draw the reconciliation between profit before tax and cash generated from operations. Now, before we even look at the question or the information, we need to know what makes up this note. What do we have to write in here? And remember, this is usually a note. So I'm just gonna fill out all the details and we're gonna do this together and try to figure out what goes in here. I hope you know it by now. So what is the first thing that always goes in your note? And sometimes they write down a few for you, not all, but maybe they'll give you some. But it's important to know all, right? So what goes first in your note? Okay, first we have net profit. But it's not just any net profit. Is it net profit before? Why is this underlying? No, I don't want underlinings. Go away. Okay, so is it net profit before or after tax? It's net profit before tax, right? So that's number one. Now, in order to reconcile the net profit before tax and all the cash, we're going to have adjustments. And usually there are two adjustments. So not always, but here we're just going to do two adjustments. And in respect of, first is interest expense. Now, why are we adding back interest expense? Remember, interest expense is a finance cost, and we're going to delete it, okay, because it's going to appear separately in the cash flow statement. I hope you know what an entire cash flow statement looks like, and it's going to appear separately, so we can add it back here. And then the next adjustment is going to be depreciation. And why do we add depreciation back? Because remember, we are trying to find out what are the cash outflows, what are the cash inflows. We only want to look at cash. And remember, depreciation is not really a cash expense. It's an imputed expense. That means it's not really taken from our money, right? And then what we do next is we add amounts 1, 2, and 3 to give us this amount. And what do we call this amount if we add all three? It is called operating profit. Operating profit before changes in working capital. Okay, so this amount here is going to be a total of these three. But this amount below that, net changes in working capital, this one will be the total of 1, 2, and 3. Okay, that's why I drew little green boxes around them. Now, the first thing that usually goes here is either an increase or a decrease in inventories. Okay, this can be in any order. It's just the one I remember, right? And then we're gonna have an increase or a decrease in debtors. And then last, we're going to have an increase or a decrease in creditors. Okay, and so as you can see, if it's an increase in inventories, it's going to be in brackets. We're going to subtract this amount. If it's an increase in debtors, we're going to subtract it. If it is, however, an increase in creditors, we will add it, and this will be a positive amount. And many students don't know why we do this. So remember, if we have an increase in inventories, it means we bought more. We spent money, and that's bad. We want to calculate movements in cash, right? So we decrease it. But if, for example, we increase our creditors, that means there was less cash spent. because we were buying things on credit, so we can add it. Okay, so you can remember it as if an asset increases, we subtract it. If a liability increases, we add it. Okay, and then the last thing is that we're going to add this total and this total to give us this. And this one is the final amount we want, and that is cash generated from operations. Okay, so you need to learn all these items that go into this reconciliation, and that's the only ones we're doing here and we're doing now. There are more, there is always more, but for now, this is what we're going to be focusing on. And in the next video, I'm going to look at the question and write in the amounts.